If Warren Buffett had to start from zero today, he claims there are only 5 companies he'd trust for life. But most investors completely misunderstand why. They think it's about brand names, safe profits, or long track records, but that barely scratches the surface. What Buffett actually looks for is far more unusual, and in some cases quietly controversial. Because behind each of his hold forever stocks is a hidden advantage that most people never spot on a balance sheet. And a deeper reason he believes these companies could survive storms that would wipe out the rest of the market. Some of these picks have sparked debates for years, with analysts arguing that Buffett's loyalty defies logic. Others have built moats so deep that even their biggest competitors admit defeat. Today, we're pulling back the curtain. Not to repeat the same obvious talking points, but to uncover the real forces that make these 5 companies Buffett's lifelong bets. And the truth behind them might just change how you think about investing forever. Because once you understand what Buffett sees, you'll never look at these companies the same way again. Why Buffett almost never sells. For most investors, buying a stock is a trade. For Warren Buffett, it's a commitment. He doesn't think like someone hunting short-term gains. He thinks like a business owner stepping into a partnership that might last a lifetime. And that mindset explains why he almost never sells. To him, every share represents a piece of a machine that should keep printing cash long after he's gone. But this approach has stirred plenty of debate. Rumors and criticisms have followed him for years, especially as modern markets move faster and algorithms dominate trading. Some analysts argue Buffett is too slow, that he's stuck in an older era of investing. Yet ironically, it's that same steady, boring patience that keeps outperforming the chaos. While others chase hype cycles that rise and collapse within months, Buffett quietly holds companies that grow stronger with every downturn. Compounding is simple math, but most people never see its full power because they keep jumping in and out of positions. Buffett avoids that trap. He knows that real wealth comes from letting time do the heavy lifting, allowing a proven business to expand, reinvest, and snowball far beyond what quick trades can deliver. And the first company on his list is proof of exactly that. A stock he's held longer than most people have even been alive. Coca-Cola, the cash machine behind the brand. When most people hear Coca-Cola, they picture a red can and childhood memories. But Buffett never invested for nostalgia. He invested because Coca-Cola is one of the strongest psychological brands on the planet. It's not just a drink, it's a reflex. In many countries, the name Coke is used to describe soda in general, which is the kind of mental real estate money can't buy. Yet despite this dominance, critics haven't been quiet. Over the past decade, health trends and sugar concerns sparked debates about whether Coke's future would slow. Analysts claimed the company was past its prime, and some even suggested Buffett was holding on out of sentiment rather than strategy. But the numbers tell a different story. Coca-Cola isn't a soda company. It's a distribution empire. Over 200 brands, from water to energy drinks, move through one of the most efficient global supply networks ever built. That system is so entrenched, so widespread, that even if a new beverage becomes the next big trend, Coke usually owns it, distributes it, or acquires it. But the real reason Buffett never sells Coke is something most investors never notice. It's the way the company turns brand loyalty into unstoppable cash flow, regardless of recessions, trends, or market noise. Coke doesn't just sell beverages, it sells consistency. And consistency is the currency of compounding. But Buffett's next forever pick takes this idea to a completely different level. Because unlike Coke, this company doesn't rely on global branding at all. Yet it quietly controls industries most people never think about. The secret behind Coca-Cola's power isn't in the taste or the brand, it's in the math. Buffett once explained that Coke's business becomes inevitable when you think about it in tiny, almost invisible units. If the average person on the planet drinks even a fraction of a serving per day, that microconsumption, multiplied by billions of people, turns into a tidal wave of revenue. And that's what shocked analysts. Because Coca-Cola doesn't need massive growth to dominate. Even the smallest increase, an extra sip per person per week, translates into billions flowing through its global system. That's the advantage of scale so huge, so deeply rooted, that the company can grow simply by maintaining its presence in everyday routine. Of course, the future of beverages isn't without noise. Rumors and debates swirl every year. Shifting tastes, health-conscious consumers, the rise of alternative drinks. Some reports claim the traditional soda market is in long-term decline. But what often gets missed is that Coke adapts quietly, buying into trends, expanding its portfolio, and slipping its distribution network behind whatever customers want next. It's less about predicting the future and more about making sure it owns a piece of it. But while Coke sells happiness, the next company sells something people can't live without. And that's exactly why Buffett considers it one of the safest bets on Earth. Johnson & Johnson. Johnson & Johnson isn't just a healthcare brand, it's a symbol people instinctively trust. For over a century, the company has placed its products in homes, hospitals, and emergency rooms around the world. And that trust is exactly why Buffett sees Johnson & Johnson as one of those rare businesses built to survive any era. Yet Johnson & Johnson's story hasn't been without turbulence. Over the past decade, it's faced waves of legal issues, public claims, and high-profile settlements, events that sparked heated debates about its long-term future. Reports often painted the company as being on the ropes, but every time Johnson & Johnson stabilized, reorganized, and kept moving forward. That resilience became part of its identity. Because the real engine behind Johnson & Johnson isn't hype, it's demand. People will always need healthcare. Populations age, medical needs increase, and new conditions emerge. Every year, the world becomes more dependent on pharmaceuticals, medical devices, and consumer health products, all areas where Johnson & Johnson has a massive footprint. And the company's latest move, splitting into separate divisions, wasn't a sign of weakness. It was a strategic reset. By carving out its consumer health business, Johnson & Johnson sharpened its focus on the higher-margin, faster-growing medical and pharmaceutical segments. In other words, it doubled down on the areas where it already quietly leads. But the most surprising part of Johnson & Johnson isn't their medicine. It's the way they dominate entire markets without most people realizing it. From surgical tools to advanced therapies, Johnson & Johnson often controls the supply chain long before a product ever reaches the public. And Buffett's next pick takes this idea of invisible dominance even further. Into an industry where one company became so essential, the world can't function without it. What makes Johnson & Johnson truly unmatched is its rare level of pricing power, the ability to raise prices without losing customers. Most industries can't get away with that. But healthcare is different. When a product is essential to someone's well-being, demand doesn't rise and fall with the economy. People don't cut back on medicine the way they cut back on vacations or gadgets. They buy what they need when they need it. That's the economics of necessity, and Johnson & Johnson sits right at the center of it. And the future only magnifies this advantage. Around the world, populations are aging at record speed. More seniors mean more treatments, more devices, and more long-term care. Reports have been predicting this demographic shift for years, and now it's accelerating. For companies like Johnson & Johnson, that's not just stability, it's decades of built-in growth. Combine that with its global network, its product depth, and its ability to weather legal storms, and you start to see why Buffett views Johnson & Johnson as a forever business. Not because it's flashy, but because it's essential. But if Johnson & Johnson takes care of your health, the next company on Buffett's list takes care of everything else in your life. A business so woven into daily routine that most people don't even notice how often they rely on it. Procter & Gamble. Procter & Gamble isn't a company people think about, because they don't have to. It's already in their lives. From the moment billions of people wake up to the moment they go to sleep, Procter & Gamble is there, quietly powering the daily rituals everyone takes for granted. Toothpaste, detergent, shampoo, soap, razors, the list goes on. And that's exactly why Buffett loves it. Procter & Gamble doesn't just sell products, it sells habits. The kind that form in childhood and stick for decades. Many of its brands, like Tide, Gillette, Pampers, and Oral-B, aren't just market leaders, they're cultural defaults. Parents who grew up using them often buy the same products for their kids, creating a cycle of loyalty that no marketing campaign can replicate. But even a company this dominant faces debates. Some investors point to the rise of private label alternatives, store brand detergents, no-name soaps, budget razors. They argue that price-conscious consumers could chip away at Procter & Gamble's dominance. And while that's a real discussion, what many overlook is that Procter & Gamble's advantage doesn't come from price. It comes from trust, familiarity, reliability. Those emotional anchors are almost impossible to replace, even with cheaper options. And Procter & Gamble uses that trust strategically. With its massive scale, it can outspend competitors on research, distribution, and retail placement, making sure its products are always front and center. That visibility alone keeps millions choosing Procter & Gamble without thinking twice. But while Procter & Gamble is the king of your home, the next company owns the world on the go. A business so far-reaching that it touches your wallet every time you shop, travel, or simply move through modern life. McDonald's, the hidden real estate empire. Most people think McDonald's makes its money selling burgers, but Buffett knows the real truth. McDonald's is one of the most powerful real estate empires on the planet. The restaurants are just the front-facing part of the business. Behind the scenes, McDonald's owns the land beneath thousands of its locations, and that's where the real money comes from. Every franchisee pays two things, rent and a percentage of sales. That combination creates a steady, almost unstoppable stream of cash. Even if a single restaurant struggles, McDonald's still collects. If it thrives, McDonald's earns even more. It's a financial model so effective that many analysts say the company could remain profitable even if it never flipped another burger. Of course, debates still follow the brand. Critics point to rising health-conscious trends, shifting consumer tastes, and the surge of niche food chains. Reports claim younger generations are moving on from traditional fast food. But here's what often gets missed. McDonald's adapts faster than people think. New menus, digital ordering, delivery systems, and global real estate expansion keep the company locked into daily life, no matter how trends evolve. Buffett sees the stability behind the counter, not the food on the tray. A company that owns prime real estate, collects rent indefinitely, and grows simply by opening doors in the right locations. But if McDonald's dominates when people are hungry, the next company dominates when people need everything else. A business so woven into modern living that you interact with it constantly, without ever realizing you're part of its profits. Walmart, the retail superpower. Walmart's dominance didn't happen by accident. It's the result of a powerful flywheel that, honestly, few companies in history have ever been able to replicate. Massive scale leads to lower costs. Lower costs attract more customers increase volume, and higher volume gives Walmart even more scale. That loop spins faster every year, turning the company into a retail force that's almost impossible to challenge head-on. But in the age of online shopping, a lot of investors wondered if Amazon would finally break that cycle. There were rumors, debates, and endless comparisons filling headlines, with some analysts claiming Walmart was too slow to compete in a digital-first world. Yet, behind all that noise, something unexpected happened. Walmart quietly became one of the strongest omni-channel companies in the country. Its secret? Stores as fulfillment hubs. With thousands of locations already spread across neighborhoods and cities, Walmart had a built-in logistics network long before e-commerce really took off. That meant faster delivery, cheaper pickup options, and the ability to reach millions of customers without relying on faraway warehouses. While online competitors raced to build distribution centers, Walmart was already standing on one. And its strength shows up in every economic cycle. When times are good, shoppers come for convenience. When times get tough, they come for prices. Either way, the doors stay busy, and the flywheel just keeps turning. But Buffett's real lesson isn't the companies, it's the mindset behind choosing them. A way of thinking that explains why these 5 businesses earned a place on his forever list, and why, honestly, most investors never see the full picture until it's too late. When you look closely at Buffett's forever stocks, a pattern emerges, and it has nothing to do with fancy charts or complex price predictions. It's all about human behavior. Buffett chooses companies that people rely on without even thinking. Business is so essential to daily life that even major disruptions barely shake their foundation. Whether the economy is booming or breaking, people still drink, clean, heal, eat, and shop. That's why these companies last. And their resilience creates something most investors underestimate: the slow, unstoppable force of compounding. Dividends reinvested year after year build a snowball that grows quietly in the background. While others jump between trends, Buffett lets time work for him. He ignores short-term noise, earnings surprises, scary headlines, market rumors, because he knows none of it changes what these companies actually do for people. These aren't just stocks, they're habits, routines, lifelines. And as long as human behavior stays consistent, the cash keeps flowing, the dividends keep rising, and the compounding keeps accelerating. But there's one more piece Buffett rarely talks about openly. A deeper principle that explains why these 5 companies stand apart from thousands of others, and why only a tiny fraction of businesses truly deserve to be held forever. Most investors lose money, not because they pick the wrong companies, but because they can't sit still. When markets crash, emotions take over. Fear rises, panic spikes, headlines scream, and people start selling in a rush just to feel safe. It's a cycle that repeats every decade, thousands of investors trying to escape the storm, only to regret it when the sky's clear. Buffett operates on an entirely different wavelength. When everyone else is hitting the eject button, he stays calm. He's lived through wars, oil shocks, recessions, inflation waves, tech bubbles, and full-blown financial meltdowns. And every time, he responds the same way, by doing nothing. Or, honestly, buying more. Decades later, the companies he held through the chaos became the ones that made him billions. Because he understands something simple, but powerful. You're not buying stocks. You're buying pieces of machines that print cash, year after year, crisis after crisis. If the machine survives and keeps producing, you win. It's the patience, not the prediction, that pays off. And that's why holding forever isn't just a strategy. It's a mindset. One built on discipline, clarity, and the ability to ignore the noise that scares everyone else out of their own future. With that foundation in place, all that's left is to bring the message home. Buffett's 5 forever companies aren't connected by industry, size, or even strategy. What ties them together is something far more important. They sell the things people rely on every single day. That's the real foundation of durability. Not trends, not hype, not predictions, just essential value delivered over and over again. And that's where Buffett's real wisdom shows itself. His success never came from chasing the newest idea or outsmarting the market. It came from choosing dependable businesses, understanding how human behavior drives them, and letting time amplify the results. Mindset, not stock picking, is what built his empire. In the end, long-term investing isn't about being the fastest or the smartest. It's about being the one who stays. Because 30 years from now, the people who quietly bought and held will be the ones everyone calls lucky. But it won't be luck. It'll be patience.